This session is going to look at the challenges facing the sector and how best to respond and ensure the financial sector and markets prosper safely in this changing environment. Please welcome the chair of our first panel, Douglas Flint, Group Chairman of HSBC.
Thanks very much and good morning. I'm joined by an absolutely outstanding panel, the Right Honourable Greg Clark, Financial Secretary to the Treasury, Andrew Bailey, the Chief Executive of the Prudential Regulation Authority, John Griffith-Jones, the Chairman of the Financial Conduct Authority, and Mark Garvin, the Chairman of JP Morgan Europe. It's a great pleasure to have the opportunity of chairing this panel on what is a fascinating topic, finance fit for the 21st century. Because as the world continues to focus on what is sustainable growth, key elements of the debate remain: how best do we harness the capabilities that exist within the financial sector towards supporting that growth? How do we build confidence that the sector has the commitment and the capacity to undertake the role we want of it? And how do we reassure broader society that the system is resolutely aligned with its own interests and the interests of its customers, and in the event of unforeseen adverse events, is structured in a way that it can be resolved safely with the least impact to the rest of the economy? So there are two aspects to our discussion this morning. The first touches on how the UK's own regulatory response fits in with the global response, how the lessons learned from the recent financial crisis are creating a stronger, a more stable, and a more effective financial system for the long term. And the second concerns the capacity of that more stable financial system to operate as a transmission mechanism for the supply of credit, risk management, payment services, all of the things that underpin economic activity and growth. Because these two aspects form the bedrock of economic expansion. And in spite of lower growth in recent years and suffering among the worst in the recent crisis, the UK remains one of the world's most open, innovative, and flexible economies. Previous economic financial crises have sometimes given rise to protectionism. The UK response since 2008 has been anything else. The Prime Minister gave a very impressive tour d'horizon of the UK's strengths. Our own experience matches this. We, HSBC, came to the UK in 1992 because London led the world as an international financial centre. Based in the UK's historic trading routes, the cluster of financial expertise resident in London, the strength and the independence of the UK's legal system, particularly in international affairs, and its sophisticated and broad services sector, as well as time zone connectivity and so on. These strengths remain just as evident today, indeed possibly more so. And the UK's commitment to supporting inward and outward investment flows is a key element of reconfirming the UK as one of the most important financial centres in the world. We are increasingly seeing our UK-based customers looking beyond the UK's traditional trade partners to the new emerging markets of China, Brazil, India, and the Middle East, and we're helping overseas investors increasingly to invest in the UK. The centrality of the City of London to the global financial system continues to rise to meet the challenges of a new economic world order. This order will bring fresh opportunities, and a very good example would be the progression of China towards its internationalization objective and as it pursues its going out policies. The first ever renminbi-denominated bond outside of Chinese sovereign territory was issued here in London just over a year ago. And London's emergence as the leading centre for the RMB outside of Asia is a reminder of our continuing ability to adapt and reinvent successfully to that changing world. So as we focus on creating long-term sustainable growth, the priority must be to create the conditions to build upon what are undoubted strengths. This means that the troika of policymakers, regulators, and the industry has to strike the right balance that allows the financial sector to support economic growth in a safe way, while creating an environment in which customers feel able to engage with the financial sector with confidence in its capacity to do the right thing, all of which are essential to economic prosperity. And so the challenges lie in the many apparent conflicts and the multiple policy objectives now being mandated. We want stability as well as growth. We demand economic growth at the same time as fiscal austerity. We want banks to lend more, as the Prime Minister said, but also grow capital both in absolute and ratio terms. We want the banking system to raise more private capital, but we sometimes want to restrict its activities and restrain dividends. We want to see more competition in financial services, but we get nervous about the higher returns that would attract external capital. We want to see fewer interdependencies in the financial world, but we like the benefits of scale. We continue to incentivize the banking system to lend ever more to governments, but we then stress test what happens if the same governments don't or can't pay. We want the system to respect market signals, but we're not always sure that we like what rating agencies say. We want greater transparency, but we fret about how immediately markets can respond to events that are not fully understood at a policy level. And finally, while we need the system to accept responsibility for optimizing credit allocation, we recognize the need to punish bank failure. So balancing all these competing priorities of all the various constituencies to deliver a workable solution without unintended consequences remains one of the greatest challenges the industry, its regulators and policymakers have ever faced. It's an enormously complicated task. But happily, it's no longer a debate about whether something should be done, but how and when. It's about managing transition, timescales for implementation, and avoiding unintended consequences. So there's a great deal to discuss, and we're privileged to have on the panel those who have all the answers. So given that the pinnacle of the debate rests with the mix of economic policy and regulation, I think it's appropriate to start with the Financial Secretary. Greg.
Thank you very much indeed, Douglas. Well, let me just make a few brief points, then we'll obviously have a discussion. First of all, just to emphasise what the Prime Minister said, there should be no doubt at all that the financial services industry in this country is of huge importance to our nation, especially in difficult times, difficult fiscal times. You know, £1 in every 8 of the taxes collected by the UK government comes from this sector. So anyone tempted to think that this is something separate from the concerns of ordinary working people, absolutely not at all. It is paying for the public services that we all depend on. It's employing, in terms of financial services and related business services, 2 million people in every corner of the UK. It is, I think we sometimes don't emphasise enough how important throughout the UK and the life of ordinary working people is the financial services industry. But I think the second thing to say is how important the global aspect is. I mean, this is a global investment conference. Now, for us to think and know that the financial services industry in this country is important to us is not sufficient reason for overseas counterparties to do business with us. The nature of global investment and global exchange is that there is mutual interest here, that there is something in it for both sides to the transaction. And I think that one of the things, again, that we ought to be re-emphasising is the importance of openness and internationalism in financial markets as in other markets to the working people of the world, to businesses around the world, to nations around the world. This is not a hypothetical or abstract notion. The more competitive and the more interconnected global markets are, the more easy it is to get the resources, get the funds from people who have them to invest, to those businesses, to those countries, to those projects that need to get them invested, to improve the conditions that people are going to have in retirement by minimising the transactions costs through competition in terms of the services that are provided. So again, I think the importance of internationalism in financial markets is something that does need to be restated, because one of the consequences of the financial crisis has been a fragmentation of some of those markets. And we know, for example, I think cross-border capital flows are still less than half of their pre-crisis peak. That is bad for everyone around the world. So we need to address some of the causes of that, and globally what we do know is that one of the causes has been a decline in trust in financial services in various jurisdictions around the world. What can we do here? Well, I think three things that I would just emphasize that in terms of policy steps we've done in the UK. One is to act quickly. You know, Anna Bottin talked about the pace of change in regulation. I think it's necessary to move quickly. Once you have experienced the crisis that we have, I think it's in all our interests that we put in place as soon as possible the correct response to that. So we are unapologetic in having moved quickly as a government elected 3 years ago. Within 2.5 years, we've legislated for and put in place the essential new architecture, regulatory architecture, that we intend to endure, and we have representatives of it here. So the Financial Policy Committee of the Bank of England having a specifically macro-prudential role. First time we've had that to look at the macro-prudential aspects of policy. The Prudential Regulation Authority, the Financial Conduct Authority to have a particular focus on those two very important aspects, and John and Andrew will say something about that in a second. They came into being the 1st of April, so they are up and running, as I say, in less than 3 years from the government having been elected. But I think the second thing to say about that is that we want to convey an accurate sense that the UK is a jurisdiction in which people can have trust and in which there is stability. But as George Osborne put it, that mustn't be the stability of the graveyard. It's very easy to achieve such complete certainty and stability that no one can do anything. And we've had that very much in mind through all of the debates of the last 2 and 3 years. So my colleagues here will know or are aware that part of their remit in the case of the FPC and part of their objectives is to have regard in various ways to the interests of long-term growth and to the economic policies of the government. So that is very much in mind, and I'm sure both Andrew and John will have something to say about the way that they balance that objective against their other objectives. And as the Prime Minister emphasised, we will be vigorous and robust in pointing out those incursions into financial regulation, especially internationally, that we think can damage that in an unhelpful way. So the design of the financial transaction tax gives us concern not just for the UK, but what that does to the prospects for global growth. It seems to me to cut against the very internationalism that I think is so important. Domestically, where we've identified particular problems, such as in corporate lending and lending to home buyers, through the Bank of England Treasury Funding for Lending scheme, we've acted on that to solve a problem that presented itself. So we will, within the framework that we've established, always and everywhere, have in mind our responsibility to help the UK grow, but also play our part in helping the world economy grow. And the final point I'd just say is banks have been the source of much discussion in recent years, but we need to be very conscious, I think especially in the United Kingdom, that the financial services sector is more than banks. You know, asset management, for example, I think you've got a session on later in the day, a hugely important area of UK strength, and that strength is available to help savers and people who want to get good returns on their investment in every jurisdiction in the world. Insurance, you've got a session on insurance later in the world. The London market, absolutely crucial to what we can offer here. And the interconnectedness of the sector, I think, is very important. And although we meet not quite in the City of London, but just down the road, I think, again, we must also bear in mind that this is not just a London phenomenon, the financial services cluster that we have here. One of my responsibilities is for the cities of England outside London. And in every one of those big cities, there is a flourishing financial services and professional services sector that is in very many ways complementary to the work that's done in the square mile. And I think it's important that we all, and in talking about what we have available to those here that are investors, also have in mind and show you what is available all around our country. So I think, as David Cameron says, we are very determined that we should move quickly to make our contribution to re-establishing one of the conditions for the re-emergence of global financial markets in the vigour that they had in the past, and that is to have trust and confidence in jurisdictions. We've been determined to do that in this country, and my colleagues will no doubt say how they're discharging that.
Greg, thank you very much indeed. So, Andrew Bailey, we don't want the stability of the graveyard. We want a financial system that will be a transmission mechanism for growth, which of course are the two objectives of the Financial Policy Committee that you sit on. And that of course is underpinned by good regulation, confidence in capital, confidence in liquidity. Now, the PRA has been in place for about 6 weeks now, but it's still an evolution of a long journey. So where do you think we are?
Well, thank you, Douglas. I agree with what has been said on this point already. I mean, I think the crisis has demonstrated to us, if we needed reminding, that the performance of the economy is crucially dependent on having a well-functioning financial system. And of course, much of the focus is on the banking system, quite rightly, although I should say that one of the things that is enjoyable about my role is that it gives me a lot more reason and time to spend time with the insurance industry in this country, which is my other major occupation, and that is something that is a real pleasure to see another big industry in this country, which is a success. But it does emphasize the crisis, the dependence of the public on the supply of critical financial services, on the ability to invest and manage savings, on credit creation, on payments, facilities. And one of the key things that stands behind the regulatory reform that we have undertaken and that Greg and his colleagues have led is that a resilient system, which is safe and sound, will better support the real economy. And the debate, and I'm going to come to the point that Anna Botan made to the Prime Minister, the debate, of course, is really then around what does that amount to, how quickly do we do it, and what is the appropriate mix of measures to achieve that. Now, there's no question that in the context of the Financial Policy Committee, in the context of the new Prudential Regulation Authority, we have put capital in the banking system at the heart of that. That is because it is about loss absorbency. And it is also, and it's a point I want to draw out particularly, about creating a distinction between dealing with what I would call legacy issues that the crisis has thrown up, and taking an approach towards encouraging future credit creation, now and in the future. There are a set of legacy issues that we believe remain to be finally dealt with. Some of those are around valuation of assets. Some of those are really on John Griffith-Jones's side to do with legacy issues to do with conduct of business. But we think that the stability and ability of the system to support the real economy will be better served by getting those issues, in a sense, dealt with more rapidly. And I distinguish that from what we have done, and we in the FPC and we in the PRA and the FSA before it have done in terms of encouraging new lending, because one of the key planks of what we're doing in terms of regulatory reform is adopting a more counter-cyclical approach. So we think it is appropriate to use regulatory tools to support new lending. And we think, by the way, that supporting new lending is appropriate for financial stability because an economy that is supported by new lending will on the whole be a more stable one in terms of the financial system. So these things all fit together. Moreover, and you have to watch where you say this in this country, we also benefit from having a banking system that has a stable and sustainable rate of return. As a regulator, some people say, well, is that really what regulators say? No, it is what regulators should say. It makes our job easier, frankly. That is an objective that I have. It is also, by the way, within that then necessary to have an appropriate distribution of those returns between retaining capital to support future lending, remuneration, and dividends for shareholders. That is a balance that, frankly, was not actually working effectively up during the crisis years and during the lead up to the crisis. But it is also something that we should all, and we certainly do, care about. Now, let me say just something about the particular point that Anna Botan made, which was about, in a sense, the pace and timing and scale of the capital changes, because it is a very important point. Now, one thing I would say is that capital is there to support lending. It is part of the liability side of a balance sheet that funds lending. What actually happened in the crisis was that in response to quite real, not only perceptions, but real evidence that there was a capital shortfall in the system, that as well as doing everything we could to boost that, there also had to be an increase in the liquidity buffers of the system. Now, liquidity buffers are tying up assets. They are tying up assets in high-quality liquid assets to counter the risk that there will be a loss of deposits and a loss of funding. And we believe, and I don't think this is a controversial point, that a more effectively and more resiliently capitalized banking system can operate on lower liquidity buffers than the ones that were built up during the crisis, where the move to increase liquidity buffers was quite violent and quite necessary. And that will support lending because that frees up capacity to lend. Now, Anna is absolutely right that, of course, we have to do this in a way that is not disruptive to the support for the real economy. But I would make the argument quite clearly that that is what lies behind our view, that we do have to tackle these legacy capital issues and put these things behind us. Now, let me also briefly say something about the funding for lending scheme, because that's obviously another important leg of what we're doing, shared with, as Greg said, with the Treasury and the government. A year ago, when the funding for lending scheme was designed, I think it's fair to say that we faced a situation where the situation in the euro area was more febrile than it is today. And we were looking at projections for lending from the UK banks in the UK that were, frankly, substantially negative. And that's the background that, together with the Treasury and the government, we took the action that we did in terms of the FLS. Over the last year, the effects that we have seen have been to quite substantially change the cost of funding for banks, and that is coming through to the cost of lending. We are seeing changes, particularly in terms of mortgage lending, but we want to see more evidence that this is coming through in lending to small and medium-sized companies. And that is why, again, a couple of weeks ago, together with Greg and the government, the Bank of England announced changes. It announced an extension to the funding for lending scheme, and it announced changes to it to provide more incentive for small and medium firm lending. Now, none of us can tell you what the effect of that will be, but what we can tell you is that we have done a lot to create the right conditions to stimulate it, and we think that's appropriate. So let me finish with just one point, which is what are we trying to do in all of this in terms of the regulatory system? Well, I was around in 1997 when the system was reformed. I think the reforms of 1997 achieved one big thing and didn't achieve another thing. They put monetary policy into a stable institutional structure that has lasted, stood the test of time. You can debate what the MPC does every month, but you can do that within an institutional structure that has stood the test of time. It's resilient. Same was not done with regulation. That is what we have to do now. I'm coming up to 28 years in the Bank of England at the end of this month. I'm on the 4th system of financial regulation. My dearest wish is that we establish something that lasts. And the test of that is if we solve the issues that I mentioned earlier and others have done already this morning. Thanks.
Andrew, thank you very much. I think there's many of us who share your wish that we'll find something that will last for a very long time. One of the advantages, of course, the Prudential Regulation Authority has is many of its measures, capital, liquidity, and so on, are measurable. But in the Conduct Authority, where there's much more focus on culture, on behavior, on conduct, we kind of know what it looks like when we see it, when we don't like it, but it's much more difficult to measure, which, John, makes your task ever more challenging. And as the first chairman of the Financial Conduct Authority, which is just as young as the PRA, an enormous task?
Douglas, thanks very much indeed. I think it is a big task indeed. Greg and his colleagues set us the not small objective of, quote, ensuring that markets work well. A few words, but quite a major undertaking. And we have three objectives under that, on which I am obsessively focused. The first one is to protect the consumer, and I think there's plenty of evidence that there is a role to play in doing just that. The second one, which is new, is to promote competition, which as a regulator we will have to grow into and are growing into very rapidly. And the third one, which is probably completely crucial to today's conference, is maintaining the integrity of the markets themselves. I have to say, as a relative newcomer to the business, that the separation between Andrew and ourselves makes eminent good sense. We obviously need to work reliably together so that things don't go down between the cracks. But it does enable us both, and certainly in my case, the FCA, to concentrate obsessively on its new duties. So I am regularly asked, given what happened over the last 5 years, what will we do that is new and what will we do that is better and or different? Let me just mention three things very briefly. The first thing that I think is of paramount importance is that we become more forward-looking and outward-facing. And that way we can hopefully either prevent entirely or at least intervene on a more timely basis to prevent bad things getting out of control. We have learned from the crisis on the Prudential side and from PPI classically on the conduct side that regulation by mopping up the mess is in fact an extremely expensive way of doing the business and gives rise to a great deal of unhappiness. Now, in saying that we as a conduct agency are going to be able to be forward-looking and preventive is easy to say, and many of my better friends have advised me that I am lining myself up for a fall, and it is unrealistic to expect that we will spot everything before it actually happens. But I think that is the task that we've been set, and I think you will see some very real changes to the way that we operate as compared to the FSA. And I'll give you two immediate examples within our first 6 weeks. One is we've published a very interesting paper on behavioral economics, which isn't saying you've got to do something, but you need to be aware that this is how customers actually behave. And the second one is the widespread discussion around interest-only mortgages, which again hasn't come with a whole plethora of rules. It's absolutely a pre-early intervention saying, look, we have a potential issue here, but we have time to solve it without getting into a sort of regulatory rules-based system. So that's the first thing, forward-looking. The second thing I think we need to do extremely urgently is to re-establish on preferably an agreed, but if necessarily an enforced basis, what our key principle, treating customers fairly, actually means. Many firms, in the light of things that have gone wrong, have already or are now redesigning the way that the products are manufactured, certainly redesigning the advice chain through which they're delivered, and in some cases redesigning the reward structures within their organization so that they don't incent any longer inappropriate behavior. But I think that unless there is a closer agreement on what, as it were, caveat emptor means in various situations, there is always the danger of misunderstandings after the event. And one of the things that the industry in particular continually asks me to be is predictable in our decision-making so that they can anticipate and indeed design things to avoid problems in the first place. And it is greatly easier to be predictable if there is an agreed set of rules in the first place by which we are playing. And I think it will have two major side effects which would be very, very important to achieve as well. One is it will restore the trust of consumers. If they know the goalposts at which we're aiming and we meet them, then they will have trust that the goalposts aren't going to move. and it will enable us to rebuild a sense of mutual respect with the firms that we regulate, because there won't be this sort of continual guerrilla warfare around what treating customers fairly did or did not mean 3 years ago when the product was first launched, never mind 15. The third item, which I think is particularly relevant for this morning, is the integrity of the UK capital markets. I think it goes without saying that our role here is to ensure that everybody's money, whether it's domestic money or international money, and whether it's sent to London or the UK for 1 hour, 1 week, or 1 decade, is looked after properly and returned in good order whenever it is required to be done so. And we have been damaged, or at least bruised, by the LIBOR trading scandal. There is no doubt about that. It's absolutely not a UK-only issue, but LIBOR unfortunately starts with the letter L and has attracted a lot of controversy. And we are absolutely determined to play our part on the insider trading front to stamp out inappropriate practices. Actually, the FSA has already made very considerable steps in this area by investment in technology and, frankly, being determined to take some what are difficult cases to court to actually get a few guilty verdicts, to send the deterrent message out to the world that London does not tolerate inappropriate behavior in the capital markets of any sort. So I think there are many more things we're being asked to do, Douglas. There are 3 for this morning. I would say, just to close this, that I don't consider the FCA as itself a business. So that's for you 2 gentlemen here to actually make money. But I would agree entirely with my colleague Martin Wheatley, who said the other day that good regulation absolutely is not a zero-sum game. There are considerable benefits both to the consumer and to the firms and to the UK GDP of having good conduct regulation. I think it's the job of the new agency to produce just that, and it's the job of everybody else to share the benefits that arise.
Well said. I think we all endorse that. You mentioned the role of markets, and I think not only just in terms of integrity, but in terms of a broader role perhaps in Europe than they have historically, as policymakers look at how long-term assets can be financed, whether there are diversified sources of finance available to broader sectors of the corporate world than have been historically, are all areas of exploration and opportunity. And it's my opportunity now to turn to Mark Garvin, who leads JP Morgan in Europe, to say a few words around that and to speak from the industry's perspective on the challenges facing. Mark.
Thank you, Douglas. It's slightly daunting to be speaking after the Minister and my regulators, but it's nevertheless a pleasure to be here and speak on this important topic. This is a very timely and apposite topic for discussion. In a way, the troika to which you referred to at the outset, policymakers, regulators, and the industry have been endeavoring since the crisis to strike the right balance and develop a sound and stable financial system that is well behaved, that protects investors as well as taxpayers, but that at the same time is conducive to growth and investment in the UK, which is the topic for today, and supportive of entrepreneurs and large businesses as well. So much of what we're doing, and certainly led by the regulators and the policymakers, is trying to strike the balance amongst those many competing priorities that Douglas illustrated at the beginning, that the industry is being asked to do. The crisis was global, but now approaching the 5th anniversary of it, the manifestations of that are varied across the globe. And Christine Lagarde has referred to a global, 3-speed global economy, whereby some economies, mostly the emerging markets, are moving at considerable speed, others are on the mend, whilst others, and many of those in Europe, are actually operating at very low to negative growth. There are reasons for that, in Europe, which have to do with rectifying fiscal imbalances, healing banking systems, as Andrew mentioned earlier, and also some of the structural rigidities on the continent. But that's not the topic for today. I'd like to just draw attention to one significant topic which was the case before the crisis and remains the case, and that is the way intermediation is done in Europe and how that compares with the United States, and suggest that perhaps one of the many reasons why the US is moving at a different speed since the crisis has to do with the nature of the intermediation. And that is that basically, before the crisis and still today, approximately 80% of financial intermediation in Europe is conducted through the banking system. That means that only about €1 trillion euros of intermediation are occurring through the banking, outside the banking system. Now, clearly, that is a huge difference from the US, where the reverse is true. 80% of intermediation is occurring outside the banking system in the United States. So I think there is probably a correlation between the way intermediation is done and the path to recovery. And at the same time, those facts, as I said, haven't changed, but we're now asking, quite rightly, for those entities that are conducting 80% of the intermediation in Europe to go through a very considerable healing process, which Andrew explained as well, having to do with capital, restoring liquidity, etc. Clearly, that is not a recipe that is terribly conducive to growth. I think balance has to be found. Ways must be found, finally. And this is something that policymakers and practitioners have discussed for many years, how to shift away from the dependency on banks to have capital markets do more of the contributing to growth. And I think now clearly is the time, more than ever before, to focus on that. And there are many things that can be done to do that. We can explore those as part of the questions and answers. And they have to do with ensuring that we have healthy banks, that we have resilient, active equity markets and bond markets and securitization markets, which I'm happy to discuss as part of the questions and answers. I think that those are all prerequisites to ensuring that more of this intermediation can occur outside the banking system. And there are lessons to be learned also from the funding for lending that have been introduced in this country that perhaps are also relevant on the continent. And opportunities to explore more creative ways in concert with public sector of galvanizing the securities markets in Europe to do their part to stimulate recovery. But I want to just finish with making some comments about that most elusive of qualities, confidence, which I think is really a prerequisite to everything. And we can put all these elements in place, but the question that continues to elude us is how do we instill confidence? Well, I think it begins with thinking perhaps, I don't have an answer, and so I'm very humbly admit that I'm here to learn and I only have questions, but I think it's worth asking, what are the prerequisites for confidence? And those prerequisites include restoring a stable, healthy, resilient banking system, and that is being done. You've heard all the measures, and you're aware of the work that's being done by both regulators and practitioners to learn the lessons of the crisis and ensure that those are never repeated, and also ensure that large global institutions such as mine are able to be resolved on a global basis. And there's probably the most important initiative we have going is working with our regulators in the UK and in the US, indeed in other jurisdictions around the world, to ensure that we can be resolved safely without creating negative externalities. So healthy, stable, resilient banking systems. A predictable policy framework, and that includes a couple of things. One that is very important to the likes of us is a meaningful coordination on a transatlantic basis. And the Prime Minister referred to the Transatlantic Trade and Investment Partnership, very important initiative. I think those differences that remain between the US and Europe, really the time has come to try and resolve those so that we all can operate on a level playing field. But it also includes beginning to think about bringing the great process of global regulatory financial reform to a conclusion, and to think carefully about the remaining work that needs to be done so that policymakers and the regulators, our new regulators in the UK, can actually begin to implement, do the work they've been tasked to do, supervise the institutions that need to supervise, and the practitioners like us know the rules that we must operate under. So some stability, predictability in terms of policy framework, I think, are fundamental to restoring confidence. And then finally, I think avoiding further policy errors. And I'm very happy that the Prime Minister and the Minister both referred to the financial transaction tax as an example of a flawed initiative as it's currently drafted. And I think we have to be very, very alert to the risk of policy errors. At the same time, we have to consider the collective implications of all the initiatives that have taken place and how they will ultimately play out in the remainder of the decade and going forward, so that we don't have to have another regulatory reform process, as Andrew much wishes and none of us wants to see, and relearn some of the lessons that we learned in the past.
Mark, thank you very much. In the interest of time, I'm going to ask a few questions, but if I can ask my fellow panelists to keep the answers concise as we're coming to the end of this session. If I can turn first to the Minister. A successful economy does depend on a sustainable supply of finance and an effective transmission mechanism. Quickly, what more would you like to see our industry do to support government growth objectives?
Well, let me give you an example of corporate lending to small businesses. I think we've recognised that there's been a problem with this. First of all, the available funding wasn't there, so funding for lending was designed to make available that funding, and I think it's been successful in those terms. But looking at how it has been transmitted to the real economy, the one area where I think the progress hasn't been fast enough has been to small and medium-sized enterprises. So that's why the refresh of the funding for lending scheme has increased the incentives and increased the availability of funding specifically for SME lending. So that's, from the policy maker's point of view, we've done that. But it does require, and I know this is the forefront of the minds of the banks on the panel and in the hall, that needs to be transmitted to small businesses. And I think there is, I know from my discussions with small businesses and their representative organisations, sometimes there is a fear that a loan application is going to be declined, and the fact of it being declined, if they've got a long-standing exclusive relationship with a bank, is the only place to turn, and to, as it were, to sort of hawk their application around different banks is just going to impair their standing in terms of their credit history. Now, I think there are things that the banks collectively can do to engender more confidence. For example, it is a fact, I think too little known, that the great majority of funding applications by small and medium-sized businesses are approved. The perception that one sometimes picks up is that people think that that is less dependable. There is also, introduced by the BBA in recent months, an appeals system, so that any small business that makes an application for lending, if it's declined, can appeal, and that is overseen independently. And there is a 40% rate of those decisions being overturned. Now, that gives rise to two, I think, challenges to the banks. 40% is quite high, which suggests that the decision-making process needs to be reviewed as well to make it more dependable. But secondly, sadly, there's a very limited take-up of this appeals mechanism, notwithstanding its great success. I think that should be much better promoted and made available to small businesses, so that they can begin to have some greater confidence that the mechanisms that are in place actually can result in funds being made available to them.
Yeah, I think we're on a journey, and I think we need to communicate much more actively with governments on this, because I'm sure there are challenges and barriers to be overcome, and also myths to be challenged. But we're all in the same space. Andrew, two very, very quick ones for you, if I may. Picking up comments that Mark made, I made, and Anna made. I mean, how much more is going to be put on the table in terms of regulatory? How close are we to the end of at least seeing the menu from which we're going to frame the final regulatory rules? And secondly, we hear a lot about regulatory fragmentation. Do you worry about the UK's reputation in terms of commanding respect and trust from overseas peers? Because I think that is crucial to an integrated global regulatory architecture.
Well, very quickly, I think that I share the view that we have to give clarity to the industry and those who use the industry of what is to come. And I therefore share the view that we have to, in a sense, give a clear message that we're drawing to a close the sensible response to the crisis. I think one of the big things that remains to be done is something that Mark referred to, which is the whole question of nailing resolution and recovery for the biggest banks. This, of course, if you like, is the solving the too big to fail problem. We've made a lot of progress, I think, over the last 5 years, but I don't think any of us involved in it underestimate what is still to be done. And if one thing unlocks, I think, progress across broader fronts, it's that, which is really the answer to the second question. The pressure for fragmentation, in my view, which is very real, by the way, comes from not being able to trust what I might call sort of robust cross-border solutions to these problems, because it then defaults to national solutions, because when things go wrong, they hit at the national level. So it is absolutely crucial for that reason that we solve this problem of too big to fail and trust, because to do that, I think will allow us robustly to counter this pressure for fragmentation. It will bring more trust onto the table. By the way, including, and I hate to say this because it's embarrassing, trust between the authorities, but that is very real as well. So for me, that is the big outstanding thing that we have here, which Mark also referred to.
And finally, since I'm recognizing I'm going to get into trouble in a minute, John, in terms of getting buy-in to the culture, conduct, and behavior agenda that you've got, again, do you see buy-in from the industry? Do you see a shared agenda?
I do, but I think I'd close with Greg's statistic. I think you said there are 2 million people, I think it is, in the financial sector and related industries. There are 3,000 in the FCA. Now, who has the greater chance of making this a success, the 3,000 or the 2,003,000 working together? And I think if we can crack the code of mutual respect between the firms and us, and of confidence from the consumer to the institutions, we have a far better chance of success than us within the regulator acting in isolation.
It falls to me now, I think, to draw this simply to a conclusion by thanking my fellow panelists, thanking you all for listening, and to say that I hope that this has demonstrated that between the policymakers, the regulators on the two sides of regulation today, and from industry, we all have the same objectives. We've got very different roles to play, but we're aligned on where we're trying to get to. And I think the sooner we can demonstrate that to society and globally, it really will demonstrate that the UK is a wonderful place to invest in and through. Thank you very much for your attention.